Let's have a look at how you might raise money in international financial markets. And in particular, we'll look at international equity raisings and we'll look at international debt raisings. And when doing this, we'll look over what are things such as Eurobonds and Eurocurrency loans and some of the costs that might be involved in raising money in these ways. So the first thing we're going to do is we're going to look at international capital markets broadly speaking and look at the idea of cross-border equity raisings or cross-border debt raisings. So in general terms, firms can raise money through several sources. We've got sources such as just general internally generated cash, which is going to rely on using your retained equity. But more relevantly in this context, you can have short-term external funds or long-term external funds. The short-term external funds would be things such as short-term debt. They would go into current assets or current liabilities, as the case might be if it's a debt or an asset. So it would be something that would have a maturity of less than 1 year if we've got a current liability. Long-term financial instruments are going to be things such as bonds that will go for a longer time period. So when we're looking at the forms of securities that might be raised, we've got a few different categories. Firstly, we have equity, which will be things such as shares, and then you have things such as debt. Now, debt might be things such as bank loans, or there might be bonds, and this is generally a preferred form of capital raising. The reason it's often a preferred form of capital raising is because debt often has a tax shield attached to it, i.e. debt is tax deductible. As such, debt might be relatively less costly, and therefore it might be relatively more preferred than equity, because you're able to tax deduct the interest that would otherwise accrue on those borrowings. Hence, you'd be able to reduce your taxable income, which could ultimately end up benefiting you profit-wise. So if we look at this in terms of a hierarchy, we can see several different ways a multinational might raise capital. So we've got external sources, which can involve, as I've indicated, equity or debt. And you've also got debt, which can comprise debt such as bonds or debt such as loans. Now, to be clear here, these are two different types of instruments. You can have debt securities, which can involve creating a bond, and then that bond could be publicly traded. Or you have bank loans, which are typically not publicly traded unless that bank goes through some securitization process and then can trade it over the counter to another potential financial intermediary. Now, in all cases, you can have this being local or international. Now, that's the case for both equity and for debt. So it can be local in terms of your domestic stock market or domestic debt market, or international, which can involve a cross-border equity raising or perhaps issuing debt in an overseas market, or using something like a Eurobond, which is a concept we're going to get to later. Now, in a multinational as well, you can have internal sources such as retained earnings, which can often be used for raising money. So these retained earnings are going to be accrued over time through profits that might be stored internally within the company. Now, the multinational parent corporation as well, that multinational parent corporation can also retain money and can give that money to affiliates or to subsidiaries. There might be some cross-subsidization from stronger subsidiaries to weaker subsidiaries. Now, if that's done on a short-term basis for just short-term cash flow issues, that's not necessarily a bad thing. The situation where it becomes problematic is if that needs to be done consistently and repeatedly, in which case that weaker subsidiary should perhaps be divested by that parent company, i.e. the parent firm might be better off selling that weaker subsidiary to another potential buyer rather than continuing to prop it up over time. So financial intermediaries do play a key role here. Now, a financial intermediary is basically involved in helping that firm go out and raise money. In an equity context, it would be the investment bank that helps that firm to raise equity, i.e. to construct that IPO or the seasoned equity offering, as the case might be. With the debt market, there's going to be an intermediary that is going to help form that bond syndicate, so the borrowing syndicate that might enable that firm to raise money. So in either case, the intermediary plays a useful and important role in helping the firm go out and raise capital from other parties, i.e. they sit in between the firm that needs money, the firms or the parties that are willing to provide money, and they intermediate, i.e. they connect those individuals or those parties so that they're able to match their maturity demands and their investment demands, i.e. financial intermediaries are crucial in this environment, and they're typically going to be investment banks for the context of raising public securities, or commercial banks if you're going out and you're trying to do a loan of some kind. Now, in terms of raising money overseas, that's a key way of raising equity, of course. Now, it involves issuing shares on an overseas market, i.e. issuing shares if you're an Australian company on NASDAQ or NYSE if you're raising money from the United States. Or you could raise money as an Australian company in Hong Kong or Singapore or wherever you might want to do so in those relevant exchanges. Now, it's typically done for several potential reasons. These aren't mutually exclusive, but they're some of the reasons you might raise equity overseas. So, for example, you might want to do it because your home market is relatively illiquid. Now, an illiquid market is one where there might not be much active trading, or might not be much active trading for a company of your size, i.e. small companies might not receive much attention in some markets. So in that case, you might raise money overseas, say for example in the US and the NASDAQ, where you might get more liquidity. Liquidity is important because it ensures a more accurate price for your shares, which means that when you issue shares, you're going to get a better price for those securities. Also, it means that the price for your shares, by being more accurate, gives you a better indication of how well your company is actually tracking. So there's going to be more interest in your stocks if you're issuing in a more liquid market. Now, you might do that as well if the company is international. Now, in that case, you might be raising money in a market where the people are more familiar with your company. So, for example, if you're a major mining company, you might raise money in the market that is more familiar with your operations, even if your ultimate headquarters happen to be in another environment, in which case you might be raising money from the investors who are going to pay you a better price because they know more about your company. That can be the case for some specific reasons like I've indicated. There might be, most importantly, this bonding hypothesis, which is often asserted as to why firms will raise money in the United States, amongst other reasons. It's basically the hypothesis that firms want to signal to investors that their corporate governance is strong and they're solidly run. So one way to do this is to voluntarily bond themselves to more stringent corporate governance requirements, as the US is often asserted to have. So therefore, the voluntary decision to list in the US signals to investors you're a well-run company, and therefore investors might be more willing to pay you a higher price for your shares. Now, the reason for that is the US has some stringent requirements under the Sarbanes-Oxley Act and also the NYSE and the NASDAQ listing rules that require, amongst other things, you have a majority of your directors being independent and a fully independent audit committee and a fully independent nominating committee on that board of directors, which might create more oversight and discipline upon the CEOs that are operating in that market. So the decision to voluntarily accept those requirements might be an indication to investors the company might be more solidly run. Now, there might be also the idea of targeting an exchange with more favorable or more desired listing rules. Now, that's sometimes been asserted also with the United States. So the United States has, for example, what are called dual-class share structures. A dual-class share structure enables you to issue some shares that have more voting rights than other shares, which enables the founder to retain voting control over the company and therefore maintain ultimate control over how the company is going to be run. That's often asserted as one reason why the United States is an attractive exchange for some companies, and was arguably one of the reasons Alibaba listed in the United States. Furthermore, Singapore and Hong Kong have also tried to adopt such rules in relation to their issuing standards or the listing standards, so they can enable some dual-class share structures in order to attract more firms to listing on that market. Now, some exchanges might also give rise to a wider shareholder base. These are typically going to be the more liquid shares or the more liquid markets, or at least the markets where you're going to get more investors who might be more interested in trading, i.e. ones where there might be more institutional investors who might be more likely to invest in your company. This might be a company-specific aspect based on how your company is run and the nature of the company. So, for example, a tech firm might ultimately try to list in an exchange that is more favorable to tech companies and has more of a following for tech firms, such as NASDAQ, rather than listing in a more solid or a more long-term or a more mature type of exchange. So those are some reasons for you issuing equity in an overseas market. Now, international cross-listings and depository receipts are two different ways of doing this. Now, multinationals will often cross-list. The amount of cross-listing has increased quite a lot over time, and we'll see a little bit of that in a second. Now, there can be some direct costs associated with this. The direct cost of cross-listing is the cost, for example, of having to comply with those additional governance requirements in that market. So, for example, there's the ongoing reporting and governance requirements that arise if you list in the United States. As one example, in the United States, you need to rotate your auditor every few years. That implies some degree of costs, because as you get a new auditor, there'll be some upfront costs as that auditor becomes familiar with your company. So there can be some ongoing regulatory costs in that respect. There's also the ongoing disclosure costs that you need to bear in terms of the disclosure to that exchange in addition to in your home market. Now, to some extent, these can be relatively prohibitive, particularly for small companies, because it can be quite costly to comply with those regulatory standards, and hence some firms might shy away from cross-listing in some other markets. Now, there might be some other factors in general deterring firms from listing in these markets. So, for example, there's the high regulatory and compliance cost, which I already mentioned. Now, for example, over 2002, the Sarbanes-Oxley Act significantly increased those regulatory standards. So, for example, as I've indicated, it required firms to have a fully independent audit committee, which might require firms to go out and get more independent directors, which can be costly. Sarbanes-Oxley Act also imposed those auditing rotation requirements, in addition to other significant disclosure requirements, which can be costly for some firms. Now, this might deter some firms from listing in the United States because of those types of costs, and there's some evidence that this was in fact the case. Now, the ways of doing this can be through things such as depository receipts, in addition to simply issuing your shares on the market. Now, a depository receipt is basically a claim over shares in that company. It's not a share per se, rather it's a claim over shares. So it represents an original number of shares held in custody by a financial institution, i.e. it's a claim over shares as opposed to shares per se. Now that's what a depository receipt is. An American depository receipt is a depository receipt on the United States or in the United States, and it will be held in the United States. So held, for example, by the Bank of New York or JP Morgan or whatever the case might be. A global depository receipt is much the same, but it refers to a market outside the United States. So for example, London, if you're looking at the London Stock Exchange, you can have other depository receipts. So those are two modes through which you'd get equity overseas. Cross-listings have become relatively more preferred over depository receipts, but nevertheless, they're both two methods you can go about raising equity. A cross-listing is itself issuing shares on that market. A depository receipt is offering a claim over shares. The main difference here is there's different financial instruments with different disclosure requirements. So let's take a look at IPO activity in 2019, just broadly speaking, before we look at cross-listings per se. Now in 2019, there was quite a lot of IPO activity. Our major exchanges where this occurred were Hong Kong and the NASDAQ, for example. So Hong Kong was a major exchange with many IPOs, and many of these being from companies based in mainland China. NASDAQ was also a major exchange, but NASDAQ and NYSE are both quite significant. Now, NASDAQ has taken on more market share, in part because you get some more mature companies listing on it now. Saudi Arabia was a major exchange, but only really in terms of the actual market capitalization of the companies listing, not in terms of the number of IPOs. The reason for that is the Saudi Arabian exchange had one major IPO, but didn't really have that many IPOs in terms of the number, i.e. the amount here is significantly skewed by the one major IPO. So you can see that right here, with Saudi Arabia having the major IPO, and that being in the energy sector, being in oil and gas sector. So that would be why Saudi Arabia has appeared on this league table, even if it wouldn't ordinarily do so. You've got other major IPOs, such as tech IPOs. For example, Uber and Alibaba is somewhat of a tech IPO as well. So you've got major sectors as well being represented here in terms of the IPO activity. Now, what we're going to be more interested in, however, is cross-listings. So if we look at the regional shares, before we get to those cross-listings, we can see that regional shares, Hong Kong, takes up a large amount of that exchange, or a large amount of that regional share. So Asian exchanges represent the largest amount of the listings here. Now, this is both in terms of the number of IPOs and the proceeds. The US follows closely after that in general terms, depending on exactly which year you're looking at. But the US is quite a significant exchange where many firms are going to list, both in terms of the number and in terms of the proceeds. Now, if we look at cross-border IPOs are quite significant, but the exact amount of those fluctuates quite a bit over time. So these are quite significant in terms of the number. Often it's going to be very significant in terms of the exchange as well, with many listing in Hong Kong and many also listing in the United States. So you get those as being major domiciles for these international or cross-border IPOs, where a firm is issuing shares on that overseas market. So as an example, a major example of these is Alibaba, which listed in the United States as a major example of a cross-border IPO. So in terms of the top 5 cross-border exchanges, we can see here, for example, that Hong Kong was one of the largest cross-border exchanges. Now, Hong Kong would represent a large amount of the IPO activity for firms listing overseas. After that, we have 2 US exchanges, being NASDAQ and being NYSE, with NASDAQ getting slightly more cross-border activity than NYSE. But nevertheless, NYSE is quite significant. Now, part of the reason for the NASDAQ taking more activity here is probably because of the dominance of tech firms. After this, we have London, and we have NASDAQ in the EU. So that's the NASDAQ OMX exchange, which is representing European companies. The London Stock Exchange still has quite a large amount of activity, of course, being in 4th place here. Now, in terms of the top 5 exchanges, in terms of the number of IPOs, the order changes a little bit, in fact. Now, the order changes a little bit. Hong Kong is still in the top. NASDAQ and NYSE still place after this, but the ASX also appears in our top 5 here. That could be in part due to tech firms, with the ASX being relatively friendly in that respect, to some extent mining companies, but also one of the advantages the ASX has is the ASX has to some extent a slightly more flexible governance requirements, i.e. the ASX has a comply or explain approach to governance, whereas in the United States you have to comply with specific requirements. So in Australia, for example, it's recommended that you have a majority of your board being independent, but that's not a forced requirement. You just have to explain why you haven't done that if it's the case that you haven't complied. So the ASX in some ways can be quite flexible and therefore quite attractive. One factor that might deter some firms, however, is the ASX doesn't have some anti-takeover provisions. So it doesn't allow poison pills, it doesn't allow dual-class share structures, it doesn't allow, for example, a classified or a staggered board, which is going to entrench managers. So the ASX has some disadvantages for some firms if they particularly want to entrench themselves. Nevertheless, in terms of the number of IPOs, the ASX does appear in our top 5. Now, if we look at the cross-border activity in the ASX, this varies quite a bit over time. Now, in some years, the ASX has very little cross-border activity. In some years, it has quite a bit more. It fluctuates quite a bit. Now, this data is from SDC, so it's not quite the same data as in the prior slide, but nevertheless, it's giving you an idea that in the ASX, there are some cross-border IPOs. But the amount of cross-border IPOs can fluctuate quite a bit, and obviously it's going to fluctuate quite a bit as a proportion of the overall IPO activity in the ASX. To some extent, this is going to correlate with the overall nature of the market. So, for example, in 2008, there was relatively little cross-border IPO activity, and in part that was because, if you really think about it, you've got the financial crisis really dominating those years, where there was A, less IPO activity in general, and therefore B, less cross-border IPO activity in specific. Now, our next one is overseas debt. Now, overseas debt would typically arise when you're raising money overseas. It's based generally if your revenues are based overseas as well, and you're trying to match up the location of your revenues with the location of your liabilities, so you can engage in some form of exposure netting, which is going to be a way of hedging foreign currency risk. Now, if your borrowings are in an overseas currency that is different from your revenues, it is going to expose you to losses if your debt is denominated in an overseas currency, but you don't have revenues also in that currency. This can sometimes be a problem for firms that need to go out and borrow in US dollars, even if they don't have revenues in US dollars. So there can be some degree of risk that can arise in this context. Now, it can be facilitated through various ways. So, for example, it can be facilitated through swaps, which is basically a situation where you go with a parent company, or go with a partner company rather, who can borrow in one particular currency, and you borrow in your home currency, and then you swap debt obligations, potentially with some degree of compensation if there's a significant amount of difference in the financial reliability of those firms. So swaps are one way of doing it. Now, we've seen other ways of hedging it as well. So you can hedge those foreign exchange exposures through various instruments. So, for example, forwards and futures, which give you the obligation to buy one currency and sell the other currency at a predetermined date at a predetermined exchange rate. You've also got options, which are going to give you the right but not the obligation to buy or sell the currency, depending on whether it's a put or a call, at that predetermined exchange rate at a predetermined date if it's a European option, or up until a predetermined date if it's an American option. Those are ways you might hedge a debt obligation if that were to accrue. So in terms of the foreign bond market, it is actually quite a major market, where firms might issue bonds or raise bonds overseas. So foreign bonds can be issued, and they're often quite common. Now, they might be issued in the domestic market, but denominated in a foreign currency, or issued in a foreign currency, but denominated in the domestic market. Either way, you might have some foreign bonds. So as an example, it might be a bond issued in the domestic market by a foreign company and issued in that local currency, i.e. the currency of that domestic market. It's then going to be subject to local laws, which is going to involve things like local bankruptcy laws, and you'll get various different types of bonds, such as bonds issued in the United States by an overseas company and the like. Often they're fixed rate, but they can be floating rates or whatever the case might be, i.e. the nature of the bond is going to depend on the exact bond terms, whether it's fixed or floating, whether there's any form of collateral requirements, any form of debt covenants that might be imposed. So those can be customized based on the nature of the contract, but you might have some standardized terms that are going to be quite common in specific markets. Now, a global bond can also be issued, which can often be a bond issued by a firm, usually denominated in dollars, but not issued by a firm based in the United States. So it might be issued and registered in an international jurisdiction, i.e. it's basically going to be one where you've got a firm that's issuing a bond in an overseas location. To some extent, it can broaden the investor base, but there can often be quite significant issuance costs when issuing these global bonds. Now, the question, of course, is it a good idea to issue debt in a low interest rate environment? Because one concept that might arise is that, say, the interest rate in your home country is very high, but the interest rate in a foreign company or foreign currency is very low, maybe you should issue the debt in that foreign currency. Now, this is a question that sometimes comes up. Now, if covered interest rate parity holds, or even uncovered interest rate parity holds, then in general terms, you can't really benefit from issuing overseas. The reason for that is the costs should be the same. Basically, you should be able to get the same rate from issuing now versus issuing overseas. The reason for that is if you're issuing in that low interest rate environment, you're going to get a currency change to reflect that relatively low interest rate. This is going to make the ultimate cost in your home currency the same, whether or not you borrow here in the domestic currency or borrow overseas. So in general terms, it won't make any difference if interest rate parity holds. And in general terms, you would therefore want to borrow in your home market, because that's going to reduce your foreign exchange risk. So if the cost of borrowing is expected to be the same, you'd want to borrow at home in order to reduce that forex risk. If this interest rate parity doesn't hold, then there might be an advantage to borrowing overseas, i.e. you might actually benefit from borrowing in the cheaper market. Now, this is because foreign exchange fluctuations can help you to some extent, and in particular, foreign exchange fluctuations can help if they result in your debt becoming cheaper. So, for example, if your home currency appreciates and becomes stronger, but the currency in which your debt is denominated becomes weaker, then paying off the debt is going to become relatively easier. So, you might actually benefit from foreign exchange fluctuations if interest rate parity does not in fact hold. So let's have a look at an example. So suppose ABC has a US $1 million payable that it expects to collect in 1 year. Suppose the interest rate on US dollars is 8%. How could ABC protect this receivable using a money market hedge? So this is an example of how you would use foreign debt potentially. So if ABC is an Australian company, for example, it might want to be hedging this $1 million payable. So if it needs to pay $1 million in a year's time, what it might do is it might want to lend this US dollars. So it's going to lend the present value of $1 million US dollars, so it's able to get $1 million in a year's time, and then in order to lend that money, it would have to borrow the money in the Australian market. So there'd be several steps here. You'd lend the present value of $1 million US dollars today, which at that interest rate would be about $925,000 US dollars. And in order to pay that back, you would do it by, in order to pay back your payable rather, you would do that by receiving your US $1 million from your lending in a year's time in order to pay your payable. So let's put some meat on this example to see how it works. Okay, so we have our company ABC, and it needs to pay $1 million US dollars in a year's time. Now, we need to see how we can hedge this. Now, we have to pay $1 million US in a year's time. Now, we'll suppose for this moment that the US interest rate is around 3%. and the interest rate in Australia is 5%, and the current exchange rate in US per Australian is 71 cents, i.e. $1 buys you 71 US cents. Now, we want to see how a money market hedge can enable us to hedge this environment, and this is going to be an example of international borrowing and why it's used. Alright, so let's have a look at our steps. Our first step is we're going to lend the present value of $1 million US. The reason for that is we have a payable in a year's time, and in order to get our $1 million in a year's time, we're going to lend the present value of it, and on our lending, we're going to receive back $1 million in a year's time. So the present value of $1 million on the interest rate of 3% is around $970,000. Importantly, this is different from our prior example because the interest rate is different. Previously, we had the interest rate of 8%, now it's 3%. Now, in order to do this, we're going to fund the present value of this $1 million in Australian dollars. So to see how that works, we've got our present value to 970,000. In Australian dollars, that's worth 970 divided by 0.71. Of course, that's the exchange rate, 0.71. So it's 71 US cents per Australian dollar. So you divide through by 0.71 to get the number of Australian dollars. Here, that's going to be 1.367 million Australian dollars. So to do that, we're going to need to borrow 1.367 Australian dollars, 1.367 million Australian dollars. And we're going to need to repay that in a year's time with interest. So you multiply it by 1.05 to get the amount of Australian dollars you need to repay in a year's time. And then you repay your US, or you use your US receivable rather from your lending to pay off your payable. So that's effectively how this works. So again, we can see this diagrammatically. So diagrammatically, we're lending our US dollars. Now, in order to finance that, we're borrowing an Australian. We need to repay our Australian dollars in a year's time. And we're also going to use the money we got from lending in US to pay off our payable. So that's effectively how it works diagrammatically. It's a relatively simple concept, but it shows the utility of being able to access international debt markets. So with that in mind, let's focus specifically on the Eurocurrency markets and see a specific example of international debt instruments. So the Eurocurrency markets are broadly speaking an environment where you're borrowing in a currency other than your home currency. So you're effectively borrowing in some form of international environment. Now, often these are denominated in dollars, and they're often freely convertible into different currencies. However, they're going to be usually dollar denominated. Now, a Eurocurrency or a Eurocurrency debt instrument is typically held with a Euro bank, which is effectively a bank that is going to hold these bonds. Now, they're generally, like I've said, denominated in US dollars, because that's going to be a relatively standardized currency to which things can be rebased relatively easily. So that's effectively what a Eurocurrency environment exists, or what a Eurocurrency environment involves. An overseas borrowing, typically in US dollars, typically with a predetermined bank or a specified bank or a specific bank that is going to enable these types of debt instruments. Now, given the growth of these, they're relatively accessible to other markets. Now, part of it has been due to relatively significant restrictions the US government in particular has placed on various US banking institutions. So US banking institutions will have to satisfy various criteria, which are going to involve reserve and deposit requirements. There are relatively special charges and taxes. There are some required discretionary or concessionary loan rates. There can sometimes be interest rate ceilings, and there can sometimes be rules in relation to competition. Now, to some extent, these can be issues when borrowing in the United States. So Eurodollar loans and Eurocurrency loans are going to be a way of trying to get around some of those regulatory hurdles in the US that would otherwise make it more difficult in order to borrow in the United States. They can often involve creation involving a chain of deposits, which effectively is going to involve multiple deposits across multiple banks, which is going to require intermediation, and that intermediary is ultimately going to use those deposits in order to finance lending. So that's effectively what these involve. The kind of borrowings, but outside the United States, hence the name, even if they are denominated in US dollars. Now, one of the important aspects of these is they're often based on floating rate debt. Now, they're often made using floating rate LIBOR rates, LIBOR being the London Interbank Offering Rate. Now, that over time is being superseded, but historically they had been denominated in LIBOR, which is effectively a standardized floating rate. Now, LIBOR represents the interest rate, and firms are going to have to pay a premium over LIBOR depending upon their risk level. So a riskier firm will need to pay a higher premium over LIBOR. So you'll often have these being denominated in 6-month terms as well. So you'll often have 6-month rollovers, so you might have a 6-month debt instrument that is rolled over time, which can to some extent be risky for firms, but it's obviously going to be a case-by-case basis dependent upon the nature of the company. Now this can be a degree of risk if interest rates change over time, of course. So these loans, of course, are going to be drawn down over time. Now the drawdown represents how much of the loan that you're enabled to borrow you've actually borrowed. I.e. you might be given the ability to borrow, say, $1 million, but if you only borrow 500,000 of that, you've only drawn down half your loan. So that's effectively what drawdown refers to here. Eurobonds are also relevant in this context. Eurobonds effectively enable companies to borrow using a bond instrument in a different denomination, a different currency from their home currency. Hence why Eurobonds come into being and are important. Now these have become increasingly important due to the use of swaps. Now swaps are very relevant to companies, enabling firms to borrow in different currencies. And as we saw in the money market hedge environment before, a Eurobond could be very useful in terms of enabling you to lock in a fixed interest rate for you to engage in that money market hedge. Now they're typically facilitated through a syndicate of banks that is going to try to find borrowers for your loans. So that syndicate of banks is important in this environment and is going to enable these large borrowers to borrow in this overseas currency. They are often going to be denominated in US dollars, but that's not essential, and they can be denominated in other currencies, and hypothetically they could be denominated in a basket of currencies, albeit that's not common. Like I've indicated, they're most commonly denominated in US dollars. They're going to have credit ratings as well, and the credit rating is going to determine how much interest rate you have to pay. And these credit ratings are going to give rise to a credit spread, which will represent the additional amount of money you have to borrow. Now, the markets have come into existence due to the need to hedge, for example, but also due to government regulation in some environments, and firms' desire to get access to less regulated loans, and to some extent, banks' desire to provide money in some relatively less regulated environments. Now, as markets become less regulated over time, the importance of borrowing using a Eurobond market might decrease, but given that these are often used by large companies and often require the use of a syndicate of banks and often require the presence of international banks in order to finance all of these loans, they will still have some role to play, particularly for large loans, due to the need to access international markets for large borrowings. They can also be particularly relevant in the environment of things like infrastructure, where significant amounts of debt are often required. Now, in terms of Eurobonds versus Eurocurrency loans, they can vary in some key characteristics. So Eurocurrency loans often use variable rates, LIBOR like I said, whereas Eurobonds are typically going to be denominated using fixed rates. Euro loans typically have much shorter maturities, i.e. 6 months if you're using the LIBOR 6 rate, so the 6-month rate, whereas Euro bonds can have, well, hypothetically any maturity, but are typically longer in nature. Bonds also have greater volume. They're more likely to be traded at least over the counter much more frequently than will a loan. Now, loans often have greater flexibility because by virtue of being a bond, some aspects are going to be standardized to some extent, i.e. there's some relatively standard terms that exist in bonds, whereas a loan, being a direct negotiation between a bank and a borrower, might have more flexibility in relation to it than might a bond. These loans might also be obtained faster, because typically they're going to involve less interaction with fewer banks, whereas a Eurobond will typically require a syndicate of banks to get off the ground, and therefore it might take longer for the borrowing to actually occur. So therefore the loan, the Eurocurrency loan, might be a little bit faster than a Eurobond. So let's have a look at an example of calculating the effective cost of one of these borrowings. Now the effective cost has two components. Firstly, the fee that arises when you're going out and doing the borrowing, and secondly, the interest that might arise. That fee is often paid to the underwriter or the syndicate because you need to pay money in order to be able to go out and actually find the borrowers. So those fees can often be important, but the question is, what is the relative cost of the fees versus the interest, and what ultimately becomes the cheapest way to go out and borrow? So let's have a look at an example. So suppose we've got Sam Miguel, a beer brewer. and they want to arrange a 250 million euro 5-year loan. Now, notably here, this is a 5-year euro currency loan. Now, they're doing this with a syndicate of banks led by Credit Suisse and Deutsche, for example. Now, we've got a few facts here. Upfront syndication fee is 2%. Now, the interest rate here is going to be floating rate based on LIBOR. So the interest rate is set as LIBOR plus 1.75%. LIBOR is reset every 6 months. What that means is your interest rate changes every 6 months and is variable. So LIBOR, in this case, we're going to look at the LIBOR as at 6 months' time. And at every 6-month interval, we're going to reset our interest rate. The initial LIBOR rate is 5.5%, but that's subject to change. LIBOR 6 here represents the 6-month LIBOR rate, that LIBOR rate that's going to hold for the next 6 months, rather. Now, the question is, what is the effective annual cost of this loan for the first 6 months? Now, we'd obviously want to look at the effective cost overall, of course. So let's have a look at how we do this. So the first thing we need to do is consider the fee. Now, the fee here is going to be our 2% of the amount we're borrowing. So here we've got 2% multiplied by the 250 million euro borrowing. So the total amount we ultimately end up receiving is going to be 245 million euros. i.e. we're paying a 5 million euro fee on just getting this loan organized. Now, the next thing we need to consider is, well, what's our first semi-annual payment? So our semi-annual payment is going to be LIBOR plus the premium, and then we're dividing that by 2 because that's an annual rate, but we only have 6 months at this point. We're looking at the interest paid per 6 months. So to see that, our LIBOR rate is 5.5%. We're paying a premium of 1.75%, so we add those together, and then we divide it by 2 to get our 6 monthly interest. Then we need to multiply that by the amount that we've borrowed, which is the 250 million. So therefore, our interest here is about 9 million euros per 6 months. So that's going to be our cost of our first 6 months. The underwriting fee of 5 million plus our 9 million in interest. And we're obviously going to need to pay that every 6 months in terms of that interest expense, as opposed to just at this one-off time period. So it can be quite an expensive loan in this environment. Now, in terms of our effective annual interest rate, let's have a look at what our effective annual interest rate is. What it is effectively is the 9 million euros that we have to pay in interest divided by how much we've actually gotten. i.e. we wanted to borrow 250, but we only actually see 245 million euros because we had to pay that underwriter fee. So our implied interest rate is then going to be based on our 245 million euros. So we have that, and then we need to multiply it by 2 because you'll notice that interest is going to be done twice. i.e. we've got each 6 months. So therefore, annually is going to be a 7.4% interest rate effectively. That's what our implied interest rate is on this borrowing. Let's have a look at another example to see again how this works. And we're going to look at 2 different proposals to see how the different cost areas can make a difference to the borrowing. So suppose we've got Siemens AG, a German company. Now it's considering 2 different debt instruments, or so 2 different borrowings. It wants to raise $500 million for the next 5 years. It can do this through Bank of America or Deutsche in our example, and they've come up with competing offers to raise this money. Now, competing 500 million euro loans. Now, suppose the 6-month LIBOR is currently 4.35% and the cost of capital is 15%. The proposals are as follows. So we've got both of them are proposing a $500 million loan. Both are for 5 years. We've got 2 different LIBOR rates here that are being offered. LIBOR plus 25 basis points and LIBOR plus 37.5 basis points. So LIBOR plus 0.375%. LIBOR is reset every 6 months in either of them, and the syndication fee is different. It's 1.125% for Bank of America and 0.75% for Deutsche. Alright, so which of these 2 loans would we choose all else equal? Now, we'd effectively choose the loan that is going to be the cheapest for us all up. Now, to see the cheapest one all up, we need to consider interest and we need to consider underwriting fees. So there's 2 heads of fees here. So let's have a look at those costs. So let's work through these costs, and we'll start with the Bank of America proposal. And the 2 types of costs were the underwriting fee and also the interest. So let's start with the underwriting fee. So the underwriting fee here is going to be based on the amount we borrow. So we borrowed 500 million, and the fee here was 1.125%. So our underwriting fee is then going to be around $5 and a bit million. So to see that, we've got 1.15% multiplied by 500 million, and we subtract that off from the amount we borrow. So we're ultimately going to see about $494 million. Now we then want to look at, well, what's going to be our cost in interest? So our first semi-annual debt payment, to get that, we take our LIBOR plus our spread. So the LIBOR was 4.35. Now our additional premium was this 0.25%. Then we're going to have that for half a year, so for 6 months. So we multiply it by 0.5. Then what we do is we multiply it by our principal amount of 500 million. So that will give us about $11,500,000 as our premium, as our interest rather. Now what we can then do is we can look at, well, what's going to be our effective cost here, our effective annual interest rate. So our effective annual interest rate is the amount of interest we pay divided through by the amount that we actually see, i.e. how much money do we actually get after we've paid the fees. Then you multiply it by 2 to get it on an annual basis. So our effective annual interest rate is 4.65%. Now we can then look at the Deutsche Bank proposal. So our Deutsche Bank proposal here, we've got different net proceeds. So we take our 500 million borrowing, of course, and our underwriting fee here was only 0.75%. So we multiply 500 million by 0.75, and that's going to give us 496 million. So that's how much we see from our Deutsche Bank loan. Now what we can then do is we can look at, well, what's going to be our interest? Well, the interest here, of course, is different. We've got our 4.35% plus our 0.375 premium. Now on a semi-annual basis, we take our 4.375 plus 4.35 rather, plus our 0.375 and multiply that by half to get a semi-annual interest. Then what we do is we multiply it by our principal amount of 500 million. So the amount of interest we're paying on a semi-annual basis is about $11.8 million. So what's our effective borrowing cost? Well, our effective borrowing cost is 11.8 million multiplied by 2, because we're doing this on an annual basis, divided through by how much we actually see from our borrowing, so the 496 million. So in this case, it's going to be 4.761%, which means that we're going to prefer our Bank of America loan in this case, because that's the one that's giving us the better effective interest rate, i.e. our effective cost from the Bank of America loan is lower. Even though the underwriting fee is higher, our ultimate cost is lower in this case. So let's have a look at the difference in the cash flows. The difference in the cash flows will come from two areas: the difference in the underwriting fee and the difference in the interest that's paid. Now I saw there was a difference in the underwriting fee. Now to see that, we take the 1.125% of Bank of America minus the 0.75% of Deutsche and multiply it by the amount that we borrow of 500 million. So the difference in the underwriting fee is about 1.875 million. But that's not the only difference, because we've also got a difference in the interest rate. Now the difference in the interest rate comes from the different premium over LIBOR. So what we've effectively got, if we've got LIBOR plus a certain amount, but we're interested in the difference in them. So we have LIBOR plus 0.25% versus LIBOR plus 0.375%, which is the Deutsche proposal. So that's effectively going to boil down to 0.375 minus 0.25 multiplied by the amount that we're borrowing. So let's see what that works out as. So we've got 0.00375 rather, which is the Deutsche amount, minus 0.0025, which is the Bank of America amount, multiplied by 500 million, which is the amount we borrow, i.e. our premium. Of course, we don't see all of it, but the interest is calculated on our principal amount rather. And then we divide it by 2 if we want it done over 6 months. All right, so our difference then is $312,000 every 6 months. Now here we've got about 10 interest payments. So that's going to add up to about $3 and a bit million. So ultimately then our Bank of America loan would be cheaper for us than the Deutsche Bank loan, because our effective cost is going to be lower with the Bank of America one, even though we have a higher upfront cost in terms of the underwriting fee. Put differently, we're paying a higher premium to Bank of America because it seems like they're able to get us a better deal on the loan, i.e. we're paying them more so they can get us a better loan arrangement. Let's have a look at another example. So suppose Citibank here offers a Eurodollar credit loan, and a Eurodollar credit loan for the government of Poland with the following terms. Principal is $1 billion US. Maturity 7 years, interest rate is LIBOR plus 1.5% reset every 6 months, which is a common term. Syndication fee is 1.75%. Now let's have a look at firstly what are the effective proceeds that Poland gets from this loan. Now to get our effective proceeds, we need to take the borrowing amount and subtract off our syndication fee. So we've got a billion minus 1.75% multiplied by a billion. So to see that, a billion multiplied by 1 minus 0.0175, which is going to be effectively what we get net of our loan costs, equals $982 million here. So that's what Poland would see from this loan. Now, what ends up happening in relation to the interest costs? So suppose we've got a LIBOR of 6.35%. The effective interest cost is going to be 6.35% plus the premium of 1.5%. So effectively 7.85%. Now obviously that can fluctuate with LIBOR over time. That's effectively what it will be to begin with. So our effective interest payment on our first 6 months will be the $1 billion that's Poland's borrowing, multiplied by 6.35% plus the 1.5% premium, and then you multiply that by a half in order to get the semi-annual interest payment. So that's how you get how much interest you pay every 6 months. So what's our effective interest rate? Well, we take that amount of interest, so $39 million. Now we need to multiply that by 2 in order to get the annual interest we pay, and then we divide through by the amount that we actually see from the loan. So in this case, about $982 million. Now what you'll notice here is our effective interest rate is higher than what the actual market interest rate is, because we need to take account of the underwriting fees that we need to pay. Hence why we get these costs that arise in this particular environment. We can see another example as well, just to emphasize this point. So suppose IBM wants to raise $1 billion and is trying to decide between a domestic offer and a Eurobond offer. The US bond can be issued with a coupon rate of 6.75%, paid semi-annually with an underwriting fee, etc., totaling 0.95%. The Eurobond would only cost 0.55% to issue, but would bear an annual coupon of 6.88%, i.e. a little bit more than the US one. Now, assuming all else equal, which of these is going to be the best one for us? Now, to see this, we can look at our total cost, for example. So the cash that we get today on the US bond is going to be $1 billion that we're raising, multiplied by 1 minus 0.95%, which is going to give us the net amount that we receive. So in this case, $990 million. The semi-annual interest is then $1 billion multiplied by 6.75% divided by 2, which is going to be 33,750,000 as our interest we pay semi-annually. So that will be nearly 70 million on an annual basis. So that's effectively what we end up with. Now, if you want to express this in the bond formula, we can see this right down here. We've got our 990 million that we actually see, i.e. that's effectively our present value, is equal to our 33 million interest each period, plus the $1 billion we need to pay back at the very end. Now, if we're expressing it that way, we can effectively calculate an IRR for our bond. Because we're effectively setting the interest rate, or the yield to maturity rather, that is going to give us the present value of 990 million based on the other parameters of this bond. So the yield to maturity here is 3.44% on a semi-annual basis. So that's what our US issue is. Now for the Eurobond, we've got a slightly different situation, but it's going to be very similar logic. So for our Eurobond here, let's first look at how much we see from the proceeds. It will be $1 billion minus 0.55%. So for the Eurobond, we're going to see 994 million of those dollars. Now let's have a look at our interest. Our interest rate was 6.88%. So on an annual basis, we'd be paying 68 million US dollars per annum on interest here. So again, if we set it up in our present value type arrangement, we've got this 994 million is equal to here our semi-annual coupon stream plus our principal we need to repay. And then we could hypothetically get an IRR from this by just using the yield to maturity that is going to force our repayments to equal back to our present value, which we've deemed to be the amount we actually see from the loan. So here our IRR on an annual basis is 6.96%. So our yield to maturity is 6.96%. So we can also look at the yield to maturities on these debt instruments if we'd want to do so. So far what we've looked at are the relative benefits and costs of issuing equity and issuing debt overseas. And we've looked at why firms might raise money overseas, both in terms of equity and debt, and some of the costs of that, and what the rationale might be for doing so. And we've specifically focused on Eurocurrency loans and on Eurobonds. And we've seen that international markets have become increasingly important over time. And in particular, firms are increasingly raising money over time from these markets, both in the form of debt and in the form of equity. We've seen how this can give rise to hedging benefits, for example, in the form of money market hedges, where firms can implicitly lock in an exchange rate for their obligations or their receipts. And we've seen how Eurocurrency loans and Eurobonds have become increasingly important in addition to just plain foreign bonds. In addition to that, we've seen the costs that arise when issuing these. So, for example, the underwriting costs, but also the interest costs. And we've seen the implicit interest rate that arises after you take those costs into account. So thanks so much for listening into this video. I hope it's been interesting for you, and I hope to see you next time. Bye.